by Amish Shah, Head of India Research at BofA Global Research, joining us this morning. Amish, always great having you. And let me first start off by trying to get your perspective with regard to the earnings growth momentum. FY27, you've penciled in an earnings growth of 10%. The street consensus is somewhere in the mid-teens or the low teens, if I can call it that. What's keeping you well below street consensus?
Sure. Good morning. Thank you for having me.
Good morning.
So I think on earnings, on one side, we are quite excited that the earnings growth momentum is improving in India. But when we compare it to the consensus, we do think that there is a shade of consensus optimism that needs to come down. And this is on the back of a few hanging factors. This includes higher crude, higher commodity prices like copper, aluminum, weaker monsoons. There is a potential for a Fed rate hike. There could potentially also be an RBI rate hike, and the risk of AI disruption, etc. So when we put in all of these factors in our bottom-up math for companies within Nifty and our coverage, we do think that 10% looks like a more achievable earnings growth for FY27 for Nifty in comparison to 13% that the consensus is forecasting as of now.
And your Nifty target as well at 26,200. How likely are we to hit that, just given the quantum of fresh paper that's coming our way? I mean, at the end of the day, there is a certain impact of flows, and domestic flows have been supportive. Foreign flows continue to be a challenge. Largely, there's not been a slew of flows coming our way, but just the quantum of fresh paper and those exiting.
So Harsh, I would loop it back to the earnings question that you asked me. Indian markets are now trading in line with long-term average valuation multiples. We do not see a scope for valuation expansion in the current time frame in the near term, but markets are likely to continue to compound in line with earnings growth. So if the earnings growth is going to be 10% for this year or FY27 more broadly, we think that markets will compound in line with, with valuations being the same. Markets will compound equal to 10% earnings growth. On the concerns that you raised, specifically related to the valuation multiples or the flows. So yes, obviously 10% market upside is not going to be a straight linear line. There will be volatility, and in the months specifically when there is a large amount of fundraise or a bunching up of fundraise, that could be weaker months for the market. But by the end of this calendar, we do think that markets will compound in line with earnings.
Understood. Just trying to get your view on flows. What's the view there? When do FIs start to come back in meaningful fashion? Is there a timeline you have in mind, or is there a view there that you have?
Harsh, on that, on a conservative basis, we don't see FII flow coming back in a big way in this calendar. So as we know, so far we are down $24 billion, or there is an FII outflow of $24 billion so far this year. And historically, the correlation between the bond yields in the US and the emerging market flows is a perfect negative correlation. And given that the bond yields in the US right now are at close to 20-year highs, this is not a great time for any emerging market, let alone India, to get flows. And then within the EM basket, obviously there is going to be a debate within whether you are bullish on tech and AI or whether you're not. In that debate, basis the clients that we speak to or investors that we speak to, most of them still want to be on the positive side of the AI trade. That basically means that India will continue to get a trickle of the FII flows. So $24 billion has been the outflow so far. We are currently in our models estimating a $35 billion of outflow on a conservative basis for the year as a whole. As far as the domestic flows goes, there we are more optimistic. On the back of the capital controls in the tax laws of India, we do think that domestic mutual funds will end up getting $60 to $65 billion of inflows for the year as a whole, 35 of which we've already seen so far until July.
Amish, you're still positive with regard to autos, and it's played out beautifully. I'm trying to understand whether there are any headwinds, one from the higher base now that we've started to build in, and second, from the fact that raw material prices are elevated, but the pass-through has been slightly delayed by automakers. I wonder if they and you are seeing any concern on the ground from a demand perspective, which is why they've not really gone out and hiked prices. Just trying to get a sense.
So look, I completely acknowledge that for the year as a whole, the current run rate of growth, which is 20+% in the industry, is not sustainable. But that is pure arithmetic, because as we know, the GST rate cuts came in September of 2020, 22nd September of last year. So till that time, the base was low, and therefore currently the growth is quite good. But in the second half of this fiscal, once the GST rate cut base comes in the second half, the growth is going to come off. So I think currently we are run rating at 20 to 25%, depending on which segment of autos that we look at. For the year as a whole, we think that it is going to be more like 10 to 12% growth. So there will be an arithmetic adjustment as we go through the year, especially after September. But at the same time, versus expectations, that is also a positive surprise, because most of us initially were of the view that auto industry will register 7-8% growth, volume growth, versus 10 to 12 is going to be a positive surprise. And raw material price impact, these companies have actually done a pretty good job at cushioning the impact. I'm not saying that there is no impact, but the margin impact, as we saw in this particular quarter as well, is to the tune of 50 to 100 basis points at max, which is very well managed. And if that sustains, we do think that there is still upside to the auto sector.
Amish, would you prefer the two-wheeler, the four-wheeler, the CV? What within auto? It's now starting to become more bottom-up, even within auto. That secular kind of move has played out to a large extent. How are you playing that?
You're absolutely right, Harsh. So it is bottom-up for us as well. But if I still have to look at the pecking order, we prefer commercial vehicles the most, that followed by four-wheelers, and that followed by two-wheelers.
Amish, hi, morning. Sajid here. Your last note spoke about the fact that there's a downside risk to Nifty of 8% odd. Even after the earnings season, do you maintain that, or the earnings took you by some positive surprise as well?
So Sajid, the 8% downside that you talk about is our bear case scenario. That's not our base case. So as I was mentioning earlier, in terms of the risks for the market, there are 6 or 7 risks which are very well flagged and known now. But the volatility in these factors can impact the markets. So if you think about it, it's higher crude prices, higher commodity prices, weaker rupee, weaker monsoons, potential of a Fed rate hike, potential for an RBI hike, and the AI disruption. So these are like 7 risks that we have to be mindful of. They're very well flagged, as I said, but clearly crude prices are very volatile, commodities are on their way up, rupee has been fairly volatile so far this year. So when you incorporate all of these risks, and if you assume that all of these 7 risks works against India, then there is a possibility that the markets comes down by 8%, but that's a bear case scenario, as I argued. In a base case, we don't think that all of these 7 will play out at once. And in our base case, we in fact argue that markets will give you 8% upside by the end of the Nifty will give you 8% upside by the end of this calendar.
And which are the sectors that will drive that upside from an earnings point of view and from valuation point of view?
So we are looking at the opportunity set in 2 baskets. The first is sectors that offer value. In other words, valuations are relatively cheaper. We would say financials, power utilities, and gas utilities fall in that basket, where we find pockets of value comfort. And then we would look at sectors where the valuations may not necessarily be cheap, but these are sectors where the growth is high and the high growth is visible. So those are stocks and sectors that the markets will continue to favor, even if they feel like momentum or crowded trades. So there we would put in sectors like autos, consumer discretionary, and more broadly within consumer discretionary, jewelry, spirits, travel and tourism, airlines, airports, so all of that as a basket within consumer discretionary we like. We like some pockets of consumer tech as well. And then we are positive on some pockets of capex and positive on aluminum and copper related stocks.
Amish, within the financials, I see that you are overweight on private banks but underweight on public sector banks. Even though public sector banks have outperformed the private sector banks in the last few quarters, why are you still bullish on private sector banks, and why do you see there's a limited upside for public sector banks?
So as of now, Harsh, I would say that the valuations are cheap across the financial space. But if you're an investor chasing growth or higher beta, then you are better off buying mid-sized private banks and NBFCs. And if you're chasing value comfort or valuation comfort, then the large private banks are cheap as well. So PSU banks, to our mind, currently will become a laggard trade. That once the mid-sized private banks, NBFCs, brokerages, exchanges, and private banks have done well, then you will have PSU banks do as a catch-up trade. Otherwise, there is no reason to first jump onto the PSU banks, whether you're seeking growth or whether you're seeking valuation comfort, which is why we think that they will relatively underperform the financial space.
Amish, what we have seen in the last month or so is basically a lot of block deals also coming into the market, a lot of paper coming in, which has a good demand coming in from the domestic funds, but largely the foreign funds are staying away from it. What's your take on why, even though these block deals are at a 4 to 5% discount to the current market prices, you don't see much of a foreign funds demand coming in for them?
So Sajid, as I said, when you look at it from the lens of a foreign investor, the first decision is that of an asset allocation, and there the equity risk premiums are right now too low in an environment of a very high bond yield in the US. So should you be in the US bond as compared to equities in emerging market, which is considered to be a risky asset? Currently, the decision is in favor of bonds. So emerging markets overall is getting very little inflow right now. And whatever inflow that the emerging markets get, then the decision from a foreign investor perspective would be that, do I want to be bullish AI and tech, in which case Korea, Taiwan scale better, or do you not want to be that part of the trade? Right now, basis our investor interactions, most of the investors want to be on the bullish side of the AI trade. So that large part of the money then gets allocated towards the tech-related trade, and therefore India gets a very trickle of that flow. So it's not an India-specific problem, but it is more of the external factors like the higher bond yields in the US and the ongoing AI tech rally driving the foreign flow decisions.
And with regard to IT, very quickly, sorry, I'm switching focus back to sectors. You've upgraded from underweight to neutral on IT. And what you're saying is that the basic reason for that is just the valuations, right? Where within IT are you finding valuations more favorable?
So Harsh, again, as you rightly said, that we are on a secular basis still concerned about IT as a sector, and that keeps us away from putting that as an overweight. At the same time, we think that when I look at positioning, FIIs are underweight, domestics are underweight, retail is underweight, and valuations on relative to the history are now relatively sensible. So can there be a short squeeze in the sector? That's absolutely a possibility. So it's more of a tactical call or a valuation-led call, as you argued, not fundamentally that we are getting bullish on IT as of now. Within IT, again, it's more bottom-up, but prefer more of the mid-caps where there is at least higher growth and visibility of that growth. And within large caps, there are one or two stocks that we prefer over the others.
Any particular sectors in the mid cap where you see good growth coming in?
More broadly within mid caps, as I was arguing that within the consumer discretionary pocket more broadly, there is good visibility of growth. So this includes hotels, airports, it includes consumer tech companies, it includes brokerages, exchanges. Within the capex pie, we think that cables and wires as an industry will continue to see good growth, between high teens to early 20s kind of earnings growth. So that's a pocket that we like. And within financials, we think that mid-sized private banks and NBFCs will also deliver good growth within the small and mid-cap space. So obviously, now there is nothing which is undiscovered in Indian market. So it's hard to generalize across sectors, but within each one of these pockets that I mentioned, there are opportunities of stocks bottom up that will continue to deliver good growth, and we think that these stocks will, as a result, do well.
Telecom is the other one where you switched to underweight, Amish. What's keeping you on the fence on this one?
So two reasons. So first of all, we were bearish on the markets for a couple of years between August of 2024 to early August 2026. And at that point in time, healthcare and telecom being the defensive sectors is what we preferred, because obviously if you're negative markets, then you want to be positive on the defensive space. Now that we are turning positive on the markets, we don't want to be in the defensive sectors. So that's one reason for telecom downgrade. But on a fundamental basis, we do think that the telecom tariff hike that the street is pricing in is quite optimistic, and these tariff hikes are going to get more protracted or pushed out. If that happens, then the valuation for the sector is not cheap. In fact, Indian telecom companies are now the most expensive telcos anywhere in the world. So if the earnings disappoint, which we think it will on the back of tariff hikes getting pushed out, we think that with higher valuations, this is a sector that can underperform.
Cement, despite this being probably the weakest quarter for cement, generally Q2, you're still bullish. I mean, you in fact upgraded cement. What's the thesis there?
So, Harsh, as you rightly said, that we were bearish on cement all this while. Now we think, most of the cost pressures. So, when the West Asia conflict was at its peak, there were concerns that crude prices will be elevated, and that will result in the pump prices being higher. And freight is a meaningful cost for cement companies. Similarly, the pet coke and the coal cost or energy in general was going up, and that could have led to cost push for cement companies as well. So we were worried about their margins, and the valuations were quite expensive. And as a result, we were bearish on cement. But in August of this year, we think that a large part of that cost pressures have already played out. Sector has corrected, or the stocks in the sector have corrected. And incrementally, when we look at the pace of the government capex versus a 11% targeted or budgeted capex growth, government is currently run rating at 13%, just in order to keep the economic growth momentum going. So we think that there could be small positive surprises on the top line, and we are not as much worried on the cost pressures anymore. And the stocks have corrected, which leads us to upgrade cement from an underweight to an overweight now.
Amish, two sectors, defense and real estate. What's your take on them?
So both these sectors, again, has been our recent downgrades. Real estate, we were very bullish because you would recollect there was a time when real estate earlier this year came down by 50% as a sector. And that was on the worries that the real estate cycle in India is over or has peaked. Our view was that the run rate of growth in the sector is going to slow down, but the cycle has not peaked yet. So we were very bullish on the real estate sector. But over the last 2-3 months, there has been a massive rally in the real estate sector. At these valuations, we now want to step aside. We think that the sector is now going to go more sideways. So we are not bearish on the cycle, but we think that the stocks are now adequately pricing for it. In the case of defense, our view is that so far it was assumed that most of the orders coming in the defense space will go to the SOEs or the PSU companies, and they will continue to make 20 to 30% EBITDA margins. They will have low working capital cycle of about 10-12 days, and as a result, these companies are making X of cash ROEs of anywhere between 50% to 180%, which is just too good to be true. And we think that over a period of time, the government is going to keep on allowing the private sector to keep coming or opening the doors for the private sector to come in the defense space. So as the competitive intensity goes up, these assumptions of 50 to 180% kind of ROEs to sustain on the back of higher margins and lower working capital, we are starting to question that. And as a result, we are not that comfortable on a valuation as far as the defense sector goes.
Okay, thank you so much, Amish, for coming in and giving us that perspective.